Hey everyone, welcome to another episode of the Remote Real Estate Investor. I'm Michael Album, and today I'm joined by Roofstock's VP of Business Development, Clayton Wyatt. And Clayton's going to be talking to us today about some of the things investors need to be aware of and things they can do to win portfolio deals. All right, let's get into it. Clayton Wyatt, thank you so much for taking the time to join us today. Really appreciate it.
Yeah, happy to be here.
And so I would love if you could give our listeners a little bit of background on who you are as an individual and what your role is at Roofstock specifically.
Yeah, who am I as an individual? I don't know if I want to
Is
bore the audience with that, but I mean, I'll give a little bit of background. Came from real estate, private equity, and investment banking. Background. Rich and I had both spent a lot of time at Jefferies covering the single family rental space, including Waypoint, which obviously Gary was the CEO of, and all the way back to when Waypoint was ramping up to go public, and we ended up merging them into a spinoff from Starwood into a public REIT, and covered them as a public company. So when Rich and Gary and Gregor had co-founded Roofstock, I stayed behind and had done some REIT coverage, mostly in the residential space, but also started to cover some prop tech companies as we started to see more of these technology companies getting into the real estate space. And so groups that were like an Open Door or an OfferPad, or Point or Unison or some of these mortgage companies, really starting to see a lot more of those groups come into the space because residential is a massive asset class, right? And so similar to Roofstock, there was a big TAM available for groups to cover. So spent a little bit of time there, and then finally got an opportunity to come over to Roofstock about 3 years ago, and primarily spending my time in the business development team, which obviously we handle the portfolio transactions, but also a lot of the JVs and interesting relationships that we've got going on there, including the recent announcement we had with JLL, that made an investment into Roofstock, and then obviously we set up a joint venture with them and with the acquisition of Stessa. So I would say majority of time spent there, but also at a corporate level, any capital markets activities. So rather that's us structuring debt or equity, but also on the investment services side where we have clients coming in that are looking for advice on putting credit facilities in place or debt products. Spending a little time there with the broader team.
Right on. So you've really seen.
That work for an overview?
Yeah, that was great. That was great. And so, for those of our listeners that might not be familiar with the private equities market, what does covering something mean when you talk about covering a REIT or covering the SFR as an asset class?
Yeah, sorry. So just as an investment, banker, you're really it's a client, driven business. And so covering a company is really, you're the point of contact for that company for all the services that the bank can offer to them. So rather it's advisory on selling a large portfolio, or accessing the public markets for either equity or debt. We're a coverage officer in the sense that if you want to do any of those services, we sort of help you set up any of those products or access those markets.
Perfect. Okay. Thanks for clarifying. So, today, what I really wanted to chat with you about is what you're seeing in the marketplace in terms of how to win portfolio deals, both on the institution side of things and then also for your individual or retail investor. What are some things that have changed in the landscape, and what are some things that folks are doing to win portfolio deals?
Yeah, so I mean, a couple of things that I would say, just stepping back first, you have to recognize the size of this market, right? And single family rental is not a new industry. It's not a new marketplace, but it's been new to institutions just over even the last decade. And SFR, we've been saying this for a while, but SFR is definitely having a moment, and the market is very hot. You're just seeing record amounts of new capital, particularly at an institutional level, flowing into the space. And if you compare that to other real estate asset classes, there's a massive gap between the the percentage of ownership at an institutional level versus the smaller retail, investors, one-off investors. So within, let's just look at multifamily residential as a comparison. I think the quote unquote institutional ownership in that space is 30-35%. And it kind of depends on how you classify institutional investors, could be a little bit higher. Within SFR, it's still 2 or 3%. So you've got
Oh
this
my gosh.
10x opportunity or more, right? To capture more of that class from an institutional level. And once you, in any of these real estate classes, once you've seen institutional money come into a space, it's not like it retracts and then exits the space, right? It just continues to be more and more institutional. So that's a huge opportunity, I think, from a retail ownership or a smaller investor ownership, because that means that your portfolio is likely going to be worth more money tomorrow than it is today, because of this cheaper cost of capital coming into the market. And so it really has been, from one of the trends, I guess it's been a supply problem, not a demand problem, right? So with an ever increasing amount of money coming into a sort of a fixed asset base, you're going to have more competition at every turn.
Yeah.
And so I think that's one of the major trends that we're watching closely. And as we take out portfolios for sale, we're just seeing more and more investors interested and more quote unquote real buyers showing up to bid on processes. And I think people are looking for ways to differentiate themselves, and for ways to get proprietary access to different deal flow channels. I think from a how do you win more deals in the market? I think it really goes into that differentiator, right? So you can, in any process, you could pay more money for a deal, right? You can be a more
Sure.
certain
Yeah.
buyer. I mean, ultimately, if you pay more money for a deal, you're going to win that deal, right? If you're the, it's kind of simple to say, but if you pay the most money in any process, you're going to win the deal. But I do think that when you're a seller, getting that certainty of close is important as well. And so when we always tell our sellers and we tell the buyers that are bidding, it's really three things. It's, how do I win a deal? It's price, terms of the contract, and then certainty of close, right? So you can win or lose a deal on those three deal points. And I think
Hmm.
that applies to, anywhere from a 10,000 home portfolio deal all the way down to a 10 home, deal, or even to a single home. So from a perspective of what are we seeing and what does it take to win deals, it's really those three things.
That I'm curious to just get your personal insights and opinion as to why do you think SFR has become this explosionary, if that's a word, asset class into the institutional world? I mean, multifamily, commercial, industrial has always kind of been there, but why now all of a sudden are we seeing institutions so interested in the single family space?
Yeah, I mean, I don't know if that's a word, but we could invent it here, and we could try to get it into the dictionary.
We'll go with it.
Well, I think it's really, it's a couple things. This has always been an asset class, and it's always been a really important way that investors have been able to grow wealth over time. It's just now becoming more relevant or apparent to institutions, because I would say in large part technology and companies like a Roofstock that can create a marketplace, can eliminate some of the friction out of the transaction or out of the management and the ownership of these assets. If you back up to, let's say, 2011, 12, 13, when companies were, institutions were buying these assets and then getting ready to take them out as public companies, there were a lot of investors that really viewed this as a trade for institutions and didn't believe that you could manage a scattered site portfolio of properties at the same efficiency or at the same scale as multifamily properties, which could be units all in one building vertically, right? Technology changed that
Right.
because you could
Right.
now, and it's been proven out now. Like I don't think that there's any question anymore of can you manage a 80,000 unit portfolio of single family rental at the same level as you could manage 80,000 units of multifamily. And so I think you have that. Let me put a pin in that for a second. But the other piece of it is we've just been
Mhm.
through a crazy pandemic where on its face, I think everybody would have thought real estate, you're going to see another massive dip in real estate values. And what actually happened over the last,
Mhm.
12 to 18 months, values went up, right? And it's a supply problem. We over the last, decade, we have underbuilt in terms of supply. And so while you see a lot of these home
Mhm.
builders rushing to build even more, even if you look back at the last decade, there's so many more homes that need to be built to even catch up with that normal, curve in terms of the amount of product that we need as a country. So I think that's magnifying the problem. But in terms of this as an asset class, the reason it's so interesting to institutions is because you can manage it at scale. The technology is there to do it, and it's a hedge against downturns. The value of home has become so much more important even during this pandemic. And I think it was apparent in the last downturn that the rental income is very durable, even during a real estate depression when prices go down. And so, during this pandemic, it was a huge winner because not only was the rental income durable, but prices were actually going up, right, during a downturn. And so I think those things have kind of made this an important asset class for investors. And you also see this iterating in different forms, right? Like the build to rent asset class has become much more it's kind of like the in vogue thing to do right now, right? Is to own, build to rent, or go accumulate assets from
Yeah.
a from that perspective. And why is that? Like that's not a new concept. I mean, if you look at Europe, they've been doing build to rent for decades, right? It's just in the U.S. where I've been calling it the gateway drug to scattered site single family rental because if you're a residential multifamily investor, you're used to having 200 units in one building. And so you weren't quite as comfortable saying, I'm going to go buy 200 units in Phoenix in a scattered site where I have to manage all these assets in different places across the MSA. But if I can buy 200 units that are contiguous and it's a build to rent community, it's an easy way for you to start getting into that single family rental portfolio. And I think that, that's important because it gives investors a comfort level that you can own and operate these similar to, other residential asset classes. And so I think in the future, it's not just going to be, is it a single family rental, residential portfolio, or is it a multifamily residential portfolio? It's just residential. And rather it's multifamily or it's single family, you're owning a house for somebody to rent, right? And that's a very important thing because where you wake up and how you feel about your home, like I think it permeates so many other areas of your life. And the best thing you can do is provide a roof over somebody's head that gives them a safe and happy like place to live. And so that's never going away, regardless of if it's multifamily, single family, or we figure out ways for people to live in co-living situations or what have you. So I think it's an asset class that's been important for years and years and years, but it's just been institutionalized, and technology has helped accelerate our ability to do that efficiently.
I think that makes a lot of sense. I think that makes a lot of sense. All right, so let's jump into talking about a little bit more in depth some of the three points that you brought up in terms of what it's taking to win a portfolio. So price, terms, and then certainty of close. So let's start with price. Where are you seeing these portfolios go with regards to list price versus what they're actually being purchased for?
Yeah, that's a hard one because, list price is difficult. And I think in some scenarios, having a list price could even hurt you, particularly in
Ah,
an, an appreciating market, right? So if you're setting a list price, you might be setting that list price too low, right?
someone could be willing to
And
pay
in some
more.
in some cases, it's yeah, and on an individual asset basis, I think it's a little bit easier to set a list price because you've got, sort of some insight into what that looks like. But at a portfolio level, I think it gets a little bit more difficult because you you're starting to see capital underwrite the cash flows. And we have this broken system of appraisals or BPOs or AVMs that, generally do an okay job on, just law of large numbers. Like you're going to get some wrong up or down, and on average, it's pretty good. But it's really built for, the one-off home that's probably going to be occupied by an owner occupant. It doesn't take into account, what folks are willing to receive in terms of cash flow, like on a yield basis, right? And I think that's a huge problem because if you're not evaluating what that cash flow stream is worth to any institution, and in a market where institutions are looking for yield, or where debt is so accretive that they're able to pay lower cap rates and cap rates are compressing, then you're going to miss the valuation of these portfolios. So, again, I think it's very difficult for me to just bogey like what are all portfolios trading at in terms of like a quote unquote list price, because a lot of times these AVMs are actually not very helpful in terms of determining where the price is going to go. And I do think it's actually a little bit of a tale of two cities here, because there are the portfolios that fit very well for an institutional investor in terms of, what are the top 10 markets in the US that the portfolio's in? What's the vintage of the house? What are the areas that it's located in? Is it a high school score neighborhood? Is it a high neighborhood score? Is it, is it in a market where rents are appreciating very quickly? And I think groups are very willing to pay up today for those dynamics in a well defined, stabilized portfolio. And we are starting to see groups pay up, pay a premium, quote unquote, for a stabilized portfolio. So, you know, uh, there's cases where we're seeing, if you back up 2 years ago, you could say you might see us pricing portfolios, or guiding on pricing of portfolios at a discount to a BPO
Hmm.
value. Today, I would argue that if for the best portfolios, you're actually seeing a premium to BPO. And on an individual basis, it might be a little bit closer to, that appraisal or BPO. But on a portfolio level, you've got a couple dynamics that are working in your favor in terms of being a seller of portfolios, because the cost of capital today is very low. And particularly on the debt side, you are seeing institutions able to, securitize these portfolios and get debt at a leverage point that's in the mid to high 80s, and at a sub 2% cost of capital. Now, obviously, there's some expenses in terms of structuring that deal and selling it into the market. But if you've got a 2% cost of capital on the debt side and you can get very high leverage, that's going to make, a portfolio very, very accretive on a current cap rate basis. And so we're seeing compression of cap rates. We're also seeing that because rent is, accelerating in some of these markets very quickly, that groups are able to really underwrite the loss to lease, or that discount to quote unquote market rent, because there's a real tangible increase, year over year or lease over lease in terms of those rental bumps. And so I think it's a combination of all those things to say, don't, the one warning I would say is, don't misprice the portfolio or set your bar, necessarily too low. But I do think it's helpful for sellers to be realistic. I'd be remiss without hitting the other side of that coin, which is there are portfolios where it's a little rougher. And if it's not right down the center of the fairway for these institutions on where they want to buy, what markets they're in, what the product type is, as soon as you start to you know diverge from that a little bit, you're starting to see bigger discounts, to a quote unquote market value for those portfolios. So rather that's small multifamily units or townhomes that don't necessarily fit an investor's buy box, or is it lower rent band homes or a little bit older homes. So I do think those things come into play, but for the very best well located portfolios, we're seeing premiums to a BPO or a quote unquote market value.
Man, that's awesome. So, in a nutshell, to wrap that up with a bow, we are seeing premiums being paid on the best located and best managed portfolios because we are seeing rental increases shoot through the roof, coupled with very low cost of capital for these buyers, these institutional buyers. Is that a fair way to sum it up?
Yeah, I think that's right. And so to just highlight maybe the 2 points I think that we even shut out there is like you got to really underwrite the upside because it's real. It's not just theoretical upside, and there's embedded gains in some of these portfolios. And it's don't focus on these AVMs because these AVMs are flawed, and it's really about the cash flow that you receive. So real cash flow matters to institutions, and that's what's important versus, what some automated valuation methodology tells you.
Yeah, interesting. It's, I back in 2014 or 15, I bought a portfolio of four duplexes right next to one another, and they were bank owned, and so we were able to get them at a discount. And it sounds like so long gone are the days of, oh, well, you're buying multiple properties in the portfolio, you should be getting a discount because you're doing the seller a favor. The Costco effect, if you will, buying in bulk. It sounds like that's no longer in play here, which is so interesting.
Yeah, I don't want to say that's completely gone because obviously like a distressed portfolio, some of these loan pools that are purchased where it's a non-performing, loan pool, you're still going to see discounts like that. And where there's quote unquote hair on a deal, you're going to have to work through to get those portfolios. But I'm just saying like, previously where you might have a perfect, quote unquote, perfect, SFR portfolio where it's, great rents, great real estate, new product, and SFR was getting a discount just because it was a new asset class.
Hmm.
Like those days are gone, right? You're seeing a convergence of multifamily cap rates and the SFR cap rates.
Got it. Okay. All right. And do you think the same is applicable on the retail side of things for retail investors? They may be looking at a portfolio of 5, 10, 15 properties. Should they expect the same things? And would you advise, recommend folks looking to underwrite in a similar fashion and that the upside is as tangible as well? Or does the dynamic shift when we go into that smaller retail investment scale?
I got to be a little bit careful here because that individual investor still has to be fairly disciplined in terms of what their cost of capital is and what their
Hmm.
return thresholds are, right? So I would say you still have to think about that on a personal level. But yes, I mean if you're buying a group of 10 properties that's in Phoenix, Arizona, and the in-place rent is $1,200, but you know that the market rent is $1,500, you should be underwriting the upside, right? Because that's a market where it's a very tangible, upside in the market rent, and it's not as big of a risk to underwrite that upside if it's really there, right? So I think that those sort of things matter, and then finding ways to operate your portfolio even more efficiently. We always talk about the gross yield or the net yield, right? Like what's your NOI margin? Well, if you've found a way to operate a portfolio at a 70+% margin and somebody else is underwriting it at a 50% margin, right? To be extreme, you're gonna more often than not beat out that other buyer because you've got a more efficient way and it's actual more dollars of cash that are coming into you as an investor.
Yeah. Yeah. I talk about that all the time in the Roofstock Academy is look at the current rent, but also look at what the true market rent is. And if there's a huge disparity there, there's real potential there for true value add. And maybe you don't even have to do anything. So I always look to see if you can't see those opportunities through that lens as a positive, as opposed to, oh, well, the market rent's 1,500, but the property in place is only getting 1,200. That's a demerit.
Sure.
If you can switch your thinking, you really have a lot of opportunity.
Yeah, I think that's right.
Okay, great. So let's move on and talk about terms. What are you seeing now in how folks are winning portfolios with more aggressive terms?
Yeah, it's super interesting because I think early on in structuring these deals, we may have done, all of ourselves a little bit of a disservice because we viewed these portfolios of assets really as individual assets,
Hmm.
and they are not getting priced or sold today as individual assets, right? Like early days selling a portfolio, rather it was 500 homes or 5,000 homes, buyers. Well, number one, there was a smaller group of buyers, right? So if it was any sizable portfolio, there was probably a handful, three or five groups that you could go to and really hope that you'd have two or three of those groups in a final round sort of bidding against each other to take down the portfolio. Today, I mean, there's 30, 50 groups that can take down very sizable portfolios. I think the terms really matter. Like before you could cherry pick and, if there was 500 homes for sale, you could bid on, 300 or 400 and really the seller would figure out, okay, what do I do with the remaining assets? Do I sell it, these 300 to this buyer and these 200 to another buyer, or do I sell, some of those on a retail basis? It's a seller's market. And so you're definitely seeing contracts become more seller friendly, um, to get deals done. So again, that and those terms, it can differentiate you as a buyer in the market. If it's a quicker closing, it's a shorter diligence period, more money that's up, in escrow that becomes hard, sooner in the process. There's, no kickouts to a portfolio. You're buying the entire portfolio that's there for list. I think that has become key in all these contracts. And I think that, without getting into the individual details of what a PSA looks like on these portfolio deals, I just think it's becoming much, much more seller friendly.
So you're seeing institutions willing to overlook some of the warts, if you will, to take down the portfolio because they're seeing the value upside potential there.
Yeah, and some of it was just kind of, like, I don't know if this is a bad example or not, but like having like a huge environmental indemnification on a pool of single family rental assets is not going to be received well from a seller, because these are homes that have gone through, environmental checks, right? Like is there a possibility that you've got, some massive, spill on a property? Maybe if it's a vacant lot, but like on an in place single family home, like that's a limited risk. So just kind of eliminating some of these quirky things that maybe buyers got away with in the past. It's pushing more of that risk from the seller to the buyer in these deals.
Got it. Wow, that's really interesting.
And it makes sense, right? Because if you're a seller and you've got two buyers and one's telling you, I'm going to give you, again, let me just be extreme. Like I'll give you a 10%, deposit up front and I'll close in 10 days. And, there's no, liability post close or anything like that. I'm buying it as is, versus someone that's saying, I'm going to give you, a 0.5%, up front, and I'm going to take, 90 days to close. and I've got all these other hooks and options in the deal, like you're going to choose the one that has much better terms, and that is a differentiating point in these processes.
Yeah. I know I've having recently sold a couple of properties, the path of least resistance is so often the easiest choice. And it's interesting because you were mentioning these, talking about these three different points, and one is the price, the terms, and then the certainty of close, which we're going to get to in a minute. But you can really play around with two out of the three to get a better uh, to do better on that third, right? So if you come in with super aggressive terms and a very high certainty of close, even if you're not the highest price, you still have the opportunity to win those bids. So I think if you can really be creative around structuring your deals, there's a lot to be had here.
Yeah, so that's why that third point I think is very important, right? It's certainty of close, which is really saying, like, are you a credible group? Or, do you have a reputation of closing deals, or do you have a reputation of retrading and not closing deals? And so that third point really ties the first two together, because if I gave you the best price and the best terms in a deal, but I was a high risk to close because I've never done a deal in the sector before. And I'm just a new entity that doesn't have that reputation of closing. That's going to hurt you, right? Or I should just say it the opposite way. If I've got a reputation of being a bad trading partner and retrading deals or not closing on time or anything like that, that matters to a seller. And so, is that worth, 1%, 10% in a deal? I don't think it's 10, but maybe it's worth 1%. I think each seller has to individually sort of weigh that risk, and they might say, listen, I've closed with this buyer before. I know they can get something done quickly. And so even though their price or their terms may not be you know as good as some other unknown buyer, I'm going to close with them because I know they can get the deal done. And so that, I think, that does matter in this market. And I should say, all else equal, on if you had the same price and the same terms, then the certainty of close definitely matters as well, because that's the thing that's going to tip them over the edge.
Right. Right. No, I think that's such an important point to drive home. And for all the sellers listening, even the one-off individual sellers or retail sellers, it's so important to weigh this in your calculation when looking at offers that you've received. Because I know that I did it. I got multiple offers on a property I was selling the first day it hit the market, and somebody offered way over ask, but they were known to do this kind of janky thing where then they jerked you around a little bit once the appraisal came in. And then I got another offer that was slightly above ask, but they put some terms in there that were really attractive. And I said, let's go for that, which technically at the end of the day was less money, but I knew that the deal was going to get done. So I think it's important not to get shiny object syndrome and just look at the number when there's so much more that goes into a real estate deal.
Yeah, and this is an important point for especially new investors coming into the market that say, well, I don't have a track record, and so, is that going to hurt me in my first deal? And maybe it does, but like the best way to overcome that is to do some deals and make sure that you're building a good reputation as a buyer, and you're not retrading in any deal. Like, if that is kind of like a poison pill. If you go into a deal and listen, absent something that's really material that wasn't understood or there from the seller in the beginning, you should not be retrading deals. You should avoid that at all costs, because that is really going to hurt you as a buyer in the market. If you come out of a deal and you agree to go in at X, let's say it's 100, and then you change the terms during diligence or closing to 100 minus X, right? You really have to start now building a reputation as a good buyer and not retrading deals, because I think that's just your poison pill to the market.
Yeah, that makes a lot of sense. And so, how do you think about retrading with regard to kind of individual investors, retail investors with one-off properties that are now getting an inspection report to review after they've made an offer? So they made an offer at 100, they get the inspection report, it's got some hair on it, let's call it $10,000 worth of work that needs to be done to get the property safe and rent ready for your next tenant. Are you still thinking that retrading is off the table at that point, or is that something that you would consider?
It's such a dangerous game to play going into a deal thinking that I'm going to get an inspection and bring the price down after I get an inspection on a couple things. Like that's nitpicking on inspection list is just trouble, right? Because you inspect any house, I don't care how perfect it is, how brand new
Yeah,
build it is, an
yeah,
inspector can find, anything wrong with it, right?
it's what they're trained to do.
So
It's
I think
right.
it's
Yeah,
got to be, yeah, I think it's got, well, there's no upside for them to miss things, right? Like it's a cover your ass sort of analysis. And so I think, you know, there are going to be circumstances where you've got a material issue and you're going to need to, solve that. And if that's a material issue to you as a buyer, it's going to be a material issue to another buyer, and the seller, items that the seller is going to have to fix, regardless, I think are items that are up for discussion. But it all depends on, sort of level setting going into a deal, right? Because if the seller is saying, hey, here's the deal, we know that it needs a new air conditioner or something else, and then you get in with a buyer, and the buyer says, well, it needs a new air conditioner, so I need another, $5,000. Well, it's all, I think, just kind of level setting when you go into the deal, so kind of here are the items if any, if it's a problem. I'm just telling you, like, that easygoing buyers are going to win more deals, right?
yeah. I think that perfectly sums it up. I think that perfectly sums it up. Um, Man, Clayton, this was awesome. This was awesome. Any final thoughts you think for investors out there that are looking at picking up portfolios or starting to think about investing in portfolios?
Yeah, I mean, listen, I would, I don't want to come off like too negative here in terms of like just saying, hey, this is a too hot of a market and it's too hard to compete because institutions have a cheap cost of capital. And so, you should just not even invest. That's not the like takeaway at all. I think the idea is like SFR is having a moment, but I still very much view this as a 10x opportunity for investors because we should be in aggregation mode because the asset class works at the numbers that are out there today. Even though you see cap rates compressing, like again, this market is going to go from a 2 or 3% institutional penetration all the way up to 20 or 30% over. My prediction is over the next, let's call it 7 years, right? So if you just stand back and say, how many homes need to be purchased, it's in the millions, right? Over that period of time. And so there's a lot of homes that need to be purchased, and don't feel like you're not the institution, because guess what? You might not be the institution today, but you're the institution, tomorrow, right? And so we can define institutional ownership at different levels, rather that's, you own 100 homes or 1,000 homes. The smaller investors today are the institutions of tomorrow, right? If you look at multifamily, that's a very real thing. These groups can grow over time. We're still in a very attractive market for investors to own this asset class, and it's only going to be, it's going to be more and more attractive over time. At some point, are we going to hit like too hot of a market and it's going to, go back down? Yes, because that's what real estate does. It might be, for some other reason that we're not anticipating today, but I do think that owning residential real estate is just a very durable way to collect current income and to build wealth over time. So it should be viewed as more, the takeaway should be it's still an attractive market to go out and own this asset class, right?
Love it. Love it. No, and I couldn't agree more. And I'm just curious, from your perspective, I mean, what size portfolio is really gaining traction and interest from institutions? Because we talk about institutions, we throw that term around a lot, but I think a lot of listeners might not be familiar with what that is or what size portfolio those institutions are interested in investing in. So do you have a gut feel or a sense for kind of where they look at what size, either in dollar amount or door count?
Yeah, it's changing. It's kind of the wrong question anymore because, before, institutions didn't have the capability, the platform, the technology to buy, you know, portfolios that were smaller than, you know, let's just say 100 homes. Today, you know, there are institutions that are buying, you know, upwards of 1,000 to 2,000 homes per month on an individual basis,
Oh,
one
wow.
by one. And
Wow.
so I don't think that it actually matters anymore. It's more like the channels that you can deliver. So if you're a seller and you've got one home, don't think that you know you can't sell to an institution. They're buying homes on a one-off basis, right?
Interesting. Okay. I did not know that. Very cool. Well, maybe cool, depending on how you, if you're a buyer or a seller.
Yeah, I mean obviously market to market matters, but no, I mean it's a very efficient market, and you know you can sell and you can buy on a one-off basis, or you can buy and sell on a, you know, a portfolio basis.
Awesome. Well, Clayton, this was great. Thank you so much for taking the time. This was gave me a lot of really great insights, and hopefully our listeners got a lot out of it too. I hope you have an awesome one. We'll have to have you back because before the episode, we were chatting about some of the additional topics we could cover, and I think you'd be a great person to do that. So look forward to picking up the conversation then.
Yeah, absolutely. All right, appreciate it.
Alrighty, everybody, that was our episode. A big, big, big thank you to Clayton for coming on the show today. A lot of meat on the bone there. Lots of good, interesting topics. I learned a ton. Hopefully, you did too as well. I know that I've been in the portfolio purchasing space for a little bit. If you are thinking about that, definitely give this episode another listen to. And we look forward to seeing you on the next one. If you like the episode, please feel free to give us a rating or review or subscribe wherever it is you listen to your podcasts.